Hey guys, and welcome to the Money Podcast. There's an old investing joke that goes like this. How do you make $1 million on Wall Street? That's easy. You start with $2 million. And lately, that's no joke. As of late May, the S&P 500 is down 17% this year, and the tech-heavy NASDAQ is down 27%. One of the worst starts to the year in 50 years. But if the way to make money is to buy low and sell high, then maybe this is the time to get in. As investing legend Warren Buffett is fond of saying, be fearful when others are greedy, and greedy when others are fearful. People are scared to death these days, so is it time to start buying, or should you wait to see if things fall even further? That's what we're going to try to figure out today. I'm your host, Stacy Johnson. I'm here with my co-host, Miranda Marquit. Hey, Miranda.
Hey, Stacy. What's up?
Well, not the market. Well, actually, it is up today, but generally speaking, no. And we also have with us our producer and novice investor, Aaron Freeman. Hey, Aaron.
Hey, guys. Waiting for that bottom.
That's what we're doing. Let's get the ball rolling, but first a quick disclaimer. Should we discuss specific investments in this show, and we probably will, don't take them as recommendations because they're not recommendations. Before you invest in anything, you've got to do your own research. You got to make your own decisions. Now let's get to it. Let's start. We've done this many times before, but let's start with describing why the market is down this year. Do you want to take a stab at that, Miranda?
I think there's just a lot of uncertainty happening right now, right? The market's been up for a while. Well, there's a lot of things, right? There's uncertainty, but also we've had a really long bull market. We've had this long run. So, we're looking at natural cycles anyway. Naturally, we're going to be having down times. And right now, just things are really uncertain. We've got inflation. People expect more interest rate hikes. We've got wars. And we've got, so there's just
high
a lot.
High gasoline prices.
Right. Yeah. High gasoline prices, there's just a lot of baby formula shortages. There's just a lot of uncertainty happening. And when people are uncertain, they kind of pull back on how much money they're putting out there. So I think there's just a lot going on right now.
Now, also, let's talk about, in case we have novices out there, and we probably do, what's a bear market? What's a bull market? What's a bear market?
Yeah, so your bear market is when the benchmark index falls 20% from a recent high. So really right now, if you're just looking at like a year to date, the NASDAQ's the only thing in a bear market right now. A market correction is when a market falls somewhere like 10 to 11% up to about 19% from recent highs. So we're looking at correction territory for the Dow and for the S&P 500. But really as of like the moment of this recording, which things are so volatile right now, who knows? It's been up 1,000 one day and down 1,000 another day. So it's hard to say, but if you're looking at a year-to-date situation, the NASDAQ so far is the only thing that's truly in bear market territory.
Yeah, down 27%.
Yeah.
And that's huge. Now, obviously, what we want to know is it going to get worse? There's no way we can know that. But you know what? Let's start this conversation off with something that happened to me just a couple of hours ago. A good friend of mine texted me and said, my mother just opened her 401k statement, and her mother's elderly and she's not wealthy. And her investments, as you might imagine, have gone down a lot. And she's alarmed. She doesn't understand the stock market. She just put money in 401k and it looked good, and now it doesn't. And so her question to me was, what should I do? Her mom wants to sell everything, which is a normal reaction for people who don't understand the stock market and are afraid of losing their life savings when they're 65 years old. And she said, "What should I sell everything?" To our advisor to sell everything. Should we move what she has into what she's in is like half in stocks? Should we move everything in the stock market so when it recovers, she'll recover her money faster? So what advice do you think I gave her, Miranda? What advice would you give to somebody who, and this must be a question a lot of people are asking right now.
I'll bet you told her to, I bet you told her to hold steady and just try not to sell low, try not to panic. Because that's the part of the issue, right? When you look at the stock market crash that preceded that happened during the Great Recession. Technically, the recession started in 2007, and the stock market crashed in 2008. But when you look at that, the folks that panicked and sold between 2008 and 2010, when the market was down, they missed out on the huge recovery to follow because now they've lost, they locked in their losses and then they missed out on the recovery. And so my bet is that if you told her to like sell anything, it was just enough cash to get her through what she needs right now and to leave the rest in is my guess.
And you would be correct. I mean, I said, I don't know how soon she's going to need this money. If she's going to need it 6 weeks from now, then, we've got to take some money out. But generally speaking, this is not a good time to sell. And another thing too, this is also a good opportunity to remind ourselves that the stock market went up 20% plus 3 years in a row. Mm-hmm. And when that happens, of course, you're going to have to take a step back when you take 2 steps forward. Life doesn't work that way. The market doesn't, trees don't grow to the sky.
Right.
Now, granted, it's really difficult. I mean, my net worth has dropped considerably in the last couple of months. And, I bought Apple at $1.50 23 years ago. And now it went up to 180 and now it's 140. And so... Right. 40, and I've got thousands of shares. So in other words, my point is, I'm watching my net worth go down, and it's freaking me out. But I have to remember, this is literally found money, I mean, of course, but once you get an idea that this is how much you're worth, it's hard to open up a statement that shows you're worth less, even though you're still way better off than you were when you began. You know what I'm saying?
Right. Yeah.
So,
well, and that's what a lot of people forget too, is it's like when they're looking at like, oh my gosh, look at how much it's down like right now. But even with it being down right now, it's still way above what it was 10 years ago. Right. So even being down off a recent high, stock market's still much higher than it was 10 years ago.
Yeah. Well, you see headlines all the time about how Warren Buffett has been going on a buying spree, or at least him and his crew. So always keep in mind that when you're selling, he's buying your stuff.
Yes.
You're selling to him, basically. So if he's buying, you shouldn't be selling.
Okay. Here's what Warren Buffett said. You played right into this. I make no attempt to forecast the market. My efforts are devoted to finding undervalued securities. So for him, the market doesn't even matter. He's just looking for good deals. Sometimes those good deals may occur when the market's high. Sometimes they may occur when the market's low. Obviously, we're more likely to find good deals when the market's low.
I have a question for you too.
What?
So you just said that the market has been grown by 20% each year, which you made it seem like it was unheard of, the growth.
It's unusual to do that 3 years in a row.
Now,
I'm sure it's not unheard of.
How much of that is just the growth in companies, the growth in their profits, and how much of that is everybody starting to invest, like the amount of human beings that are investing in the stock market?
That's a good question. And there are some variables here that we need to talk about and what makes markets high and low. And one of the things one of the benchmarks, the most common benchmark really to gauge stock prices is the price earnings ratio. Okay, so that's obviously just the price of a stock divided by how much it earns per share. If the stock's at $100 and it earns $10 per share, its price earning ratio is 10. Okay, so now the S&P 500 also has a price earnings ratio. So you can apply that formula, price earnings, to the whole market as well as to an individual company. Traditionally, the stock market trades at about 17 times the Standard & Poor's Index PE. Okay, so it trades about 17 times stock market earnings. When a few months ago, when the market was at its peak, it was trading at 30 times earnings. That's historically really expensive.
Is that attributed to more people piling into the pool?
Yes, you're right. I'm trying to circle back. Now I'm going to answer your question. There are several factors why. Yes, when people think that trees grow to the sky and everyone piles in, yes, that happens. That expands that PE. But another thing that expands the PE, and is contracting it now, is interest rates. When interest rates are really low, there's nothing else you can do with your money. So people go into stocks and maybe get dividend stocks or something like that. There's also a discounting mechanism, which we won't bother going into. But generally speaking, when interest rates are very low, PE ratios expand. And when interest rates start going back up, they contract. But certainly there's a herd mentality too, Aaron, to answer your question. Is that what you were asking?
Well, I'm trying to get to the point where maybe pre-2020, pre-pandemic, there weren't a whole lot of people putting their money in the stock market. Now we get everybody home. Everybody's looking to make money. Now all of a sudden, let's just say, for an example, you've got 3 million people are now investing in the stock market that never were there before, and they're piling all their money in. And now you're saying historically these PE ratios were like, oh, they're 17, they were 15, but now you have more people into this pile. Does that change that average PE ratio? Now we shouldn't be looking for averages of 17. Now the averages should be 20, 25?
Well, well, yes. I mean, obviously, the more people that are buying, the more it changes the overall price earnings ratio. It's going to elevate it, of course. But generally speaking, now once we understand how the market relates to earnings overall, and even individual companies, what's really important, and I write a column every week in moneytalksnews.com about exactly what's going on and what I'm doing with my money and blah, blah, blah. And what I'm telling people is, see, what we've had so far, remember price over earnings, right? So prices have come down. The stock market has fallen. Therefore, prices have come down, which makes that PE ratio lower and more appealing. It's gone from 30 to 20, okay? And still a little above its historic average of 17, but way down from the speculative 30 times earnings.
Right.
Okay, so prices have come down, making the PE more attractive. But what hasn't been reflected yet in the market to a great extent, in my opinion, is the earnings part. In other words, company stocks have come down in price, but their earnings, they're still reflecting the earnings that these companies expected to make this year. Well, if the economy contracts, those earnings are going to be less than they thought they were. So now the earnings could contract, bringing down that PE even further. And this is one reason why I'm not all in on the stock market. In fact, I've kept a lot of money on the sides. I have not bought anything yet. I'm going to start buying something soon, buying some stock soon, but I haven't done that yet. Which is
also what you just alluded to is also why a lot of people are suggesting recession, right?
Yes. Yes. Well,
because as profits of these companies, as people are pulling their money out of the stock market, as profits are coming down, companies start looking how to save money because they're not making profits. So now they're going to go to layoffs. And then if that happens, people are already paying high prices. Now you got a downward spiral of an economy.
And you know what's interesting too, that people I don't think really get to, or people don't really grasp that well, is that when the Fed is raising interest rates, let me back up a step. When the Fed was lowering interest rates, when they made the interest rate zero, that's called a Fed put. In other words, the Fed's going to make sure that asset prices go up because they're afraid of deflation. And the way they do that is they make money so cheap that it's compelling, like a mortgage rate at 3%, or these giant companies are borrowing money at 1%, and they make it so appealing that people borrow money, and that expands the economy. Okay? And that's where we've been since the Great Recession. Okay, now what the Fed has just announced, what they announced in January, the tightening, making interest rates go up. The Fed is literally their whole purpose is to crush demand. In other words, to make things so expensive that companies won't expand. So now they were our ally, and now they're our enemy. They're literally trying to make these companies less profitable, and that makes we're swimming upstream now. We were swimming downstream, and we just turned around. Now we're swimming upstream. They're trying to make these companies less profitable. They're trying to keep people from buying houses. About 40% of inflation is directly or indirectly tied to the housing market. So the first thing they can do is make mortgage rates go up. So it's harder for people to buy a house. And then those people won't be going to Home Depot to furnish that house, So, or furniture stores or blah, blah, blah. You get the message. Right. So we're literally in a scenario now where it's the worst possible investing environment. Does that mean that all stocks go down every day? No, it does not, because there's always a company that's making money somewhere. Okay, oil companies, for example. I made a ton of money in the oil companies that I have because oil prices are going up. So it's not everything that goes down in any scenario, but it's important for people to remember that as long as the Fed is committed to raising interest rates, that's making the environment for the stock market much, much more difficult. So you have to be cautious.
Now, some articles are saying, the Fed's got like 2 more 50 basis point rate hikes probably coming down the pike, and then maybe they'll stop right there. And they're saying that's already embedded in the stock market as it is. People have already sold off with that in mind. But you're saying that the earnings has yet to tell a bigger story beyond that.
Yeah, because there's two things that happen when companies announce their earnings every quarter. They say, here's what just happened. Here's how much money we made the last 3 months. And here's how much we expect to make the next 3 months. Now, those earnings estimates, with some exceptions, have not been reduced. So, and remember, what the Fed's doing is trying to make these companies not as profitable, but they're trying to keep people from buying as many widgets, or cars or houses or whatever it is. And so that's going to make their earnings go down. And so once that's acknowledged, that's why you saw Target last week, fell 30% in a day. Walmart fell 15% in a day. And that's because they came out with earnings and said, the future doesn't look so bright. And so Wall Street immediately takes these stocks behind a woodshed. I mean, Target has never fallen 30% in a day, ever.
Right.
And it did. So this is a hostile environment, and that's something that's important to remember.
That's something to actually, that's quite important. I mean, Target's a 50-year-old company? 60?
At least. I think it's more than that.
Maybe more than that.
Yeah. So now what's important too, though, is that when things go on sale, we got to go shopping. Now, I haven't pulled the trigger yet, but what I have done, and I write a column on this every week, I'm making a list. Whenever I see a stock that looks interesting, Target, for example. Actually, one I just did put on my list is Costco, which I've always wanted to own, but it was $600. Now it's $400. And so I'm like, I've always wanted to own. It's one of the most high quality companies in the United States, I think, and I really want to own it. So it's on my list. So if the market falls, that's something I want to buy. And I also I already own Google, but that's on my list to buy more of. And Amazon I own, but I want to buy more of it. I wouldn't even mind having more Microsoft. So you can look at my at these columns I write, and you can see what stocks I own. But this is the time to start thinking about what to buy and have an asset allocation strategy. In other words, I'm going to put $100,000 into the stock market in addition to what I've already got there. I'm just waiting for the right time, but I'm not going to do it all at once. I'm going to put in 10,000 of it in June, and like that, 10,000 a month over 10 months. Or maybe it's 20,000 a month over 3 months, whatever it is. Now's the time to start thinking about that. And it might even be time to put your toes in the water. I mean, there's some deals out there because there's a lot of babies being thrown out with the bathwater. In other words, good quality companies that are going down just because the market's going down. Oh, I just realized we've got to take a quick break. When we come back, we're going to talk about some strategies, what you can do, and whether now is the time to buy this bottom. Be right back right after this. Okay, so I haven't heard much from you, Miranda, and I think I know why. Tell us what your strategy is here.
Dollar cost averaging.
That's right. Dollar cost averaging into index investments. Pretty much. That's basically what I've been doing is just keeping up with the dollar cost averaging. So on days when it's dropped, then I'm just getting more shares of the index that I invest in. But I do keep money on the side so that if there is a big enough drop in something that's interesting to me, then I can buy it. And
I was going to ask you this. I was going to ask you with that plan that you do when you obviously you're doing that with whatever the market is doing, but when you do see these drops, do you put in more than your normal average?
Yeah. So I do. So if the drop is far enough, then because everything's automatic, right? So I have the automatic investing plan. So it just comes out on the same day, every week, same amount, buying the same index products. So none of that changes. It just stays on automatic. But I do have extra money off to the side. Like when I get a little extra money for something, like a tax refund, which happened this year for the first time in 10 years. But
way to go.
Yeah. So when I get a tax refund or something, I'll keep it aside in a nice liquid account. And if something happens, then I can be like, oh yeah, let's buy some extra shares of this index fund and bulk that up a little bit. I do have a couple of I do actually invest in my health savings account. And so I have a process there where, I set aside money every month to go into the health savings account, get my tax deduction. But then on top of that, every 3 or 4 months, I go in, I check and I see, okay, how much is added up in the health savings account. Okay. I want to keep about $500 in the health savings account, like with the debit card access. The rest of it, I shift into investments. And so right now, I'm actually in that part of my cycle. And so I'm looking for some bargains for my health savings account.
So you are
portfolio.
buying here.
Yeah. So I do put a little extra and I'm buying a little bit, but like you, I look for a list. I look for bargains. I look and see what's dropping. And then I look and see, has the index dropped far enough? Should I buy?
Yeah.
I did keep a little bit of, my state gave me more of a tax refund because like they cut taxes again. And so,
Nice.
yeah, my state gave me more of a tax refund than I expected. And so I went ahead and put the overage. I bought more crypto, you guys.
You bought what?
I bought more
What?
crypto. For funsies.
Oh, you did? I was
bought
going to
more
ask you about
for
crypto.
funsies. Yeah. So that's the thing.
Because crypto's turned into a
I don't
nightmare.
think it's funsies
Oh,
anymore.
it's definitely a nightmare now. And I think, but the crypto I bought I was like, so this could be a consolidation period for crypto, like the absolute worst shit coins out there. Probably gone now. Like that. This is what kills them. So this will be a good consolidation. And I am interested to see if the blue chip cryptocurrencies, as it were, make it out of this one. And so I went ahead and bought just like a little bit more Ethereum.
Yeah, and it's down. No, and actually, I have no pretense whatsoever of knowing what's going on with crypto. It could go to 1 million, it could go to 0. So what I'm saying now is strictly my own uninformed opinion. But I just noticed that crypto has been really tied to the NASDAQ because it's like a speculative security. And so when the NASDAQ goes up, it goes up, and vice versa. Well, today it's decoupled. As we speak, and not that this matters over long term, but as we speak today, the market is up huge, and Ethereum's down a lot, like 6%.
Yep.
And I have not seen that happen, so I'm a little concerned.
Yeah.
And Ethereum is, for historical purposes, around 1900 right now, 1950 or something like that.
Yeah, and
so we'll see.
And I didn't even buy a full Ether. I didn't even buy a full one. I literally was just like, well. Because it dipped below 2,000. And so I was like, you know what? I'm just going to go ahead and buy like a quarter of an Ether and call it good. Because I was just like, well, a little bit more Ether in there, I can afford to put a little bit more in there. And if it recovers, then it just adds to my portfolio, and that's fine. So yeah.
But when it comes to crypto, though, like I was just pondering, about how I look at stocks. Price earnings ratios, historical, blah blah blah. Can't do that with crypto. There are no earnings.
Right.
No.
There's nothing to compare. There are no fundamentals here at all. It's all. I mean, you might be able to do some technical analysis on it, which means looking at past price movements to determine future ones. But I just have no idea how to gauge this at all. Like I said, I've never been in an investment that for years. That I could go to $1 million or 0, and I have no idea which one's going to happen.
Oh yeah, it's
just a bizarre thing.
Yeah, it's total insanity out there, and do not do crypto unless you've got some money that you're fine just like lighting on fire. Anything you're putting in crypto today, it's like you said, it's either going to go to the moon or it's just going to. So.
Yeah. Well, I've got some specific
Stacy,
tips. Go ahead.
Yeah, I was going to ask you, like, what you're talking about buying things that are on the cheap or a good price PE ratio. Where can we go to find? Is there a way to search? Like, hey, here's a list of all the stocks that are within this PE ratio, and their fundamentals are great.
There probably are some stock screeners you can use, Aaron. But generally speaking, if you like a stock, here's what I do. Okay, I'm looking at my list now. I was just digging it up.
Because one of the things I always try to have a hard time figuring out is you can see those easily, but I don't understand where you find. Okay, so this company maybe it has a good PE ratio, but what if this company is planning on getting a loan for like $500 million to upgrade something, which is going to take away from its profits? like, where do you find this information where the company is in good standing?
Well, wherever you can. Okay, so, and I don't mean to be flippant, but you can go to MSN, you can go to CNBC, you can go to MarketWatch. There's a million different places you can get stock quotes. Wherever you can get that stock quote, you can probably get some information on the company. In other words, and another thing I do, I watch a lot of CNBC, I read a lot of articles, and when something interests me, I'll listen to what other people are saying, and then I can look at these ratios. And like, for example, I've got my stocks that are on my list. I'm looking at it right now. So one of them, okay, let me give you an example of one. I own Meta, which is Facebook.
Right.
Okay, now, and I'm going to give you guys a website you can go to for this. But okay, Facebook when I wrote this, was $190 a share. I don't know what it is right this second. Now, and it was trading at a price earnings ratio of 16. Now, it's not just what the market's doing or what a specific stock is doing. It's what has that stock done in the past. In other words, at what PE ratio does Meta generally, or over the years, has it traded at? If it usually trades at 30 times earnings, and now it's trading at 16 times earnings, that's a screaming deal, no matter what the market's doing, right? Okay, so now in order to find out what the historic PE is, because now CNBC or MSN or whatnot, they're going to give you the PE now, but they're not going to give you the PE over the last 10 years. If you want to see that, there's a website called Macro Trends, and you can get this information from them too. Free, macrotrends.com. I'm sorry, .net, okay. Macrotrends.net. Okay. And you can see the historic PE. So what I did was, I'm interested in adding to my Facebook. I've only got 100 shares of it, thinking about buying more. So it's trading at 16 times its earnings, which is historically very low, because it has traded for 25, 35 times earnings. Now, going back to what you were saying, though, Aaron, now I've got to look at other things, though.
Because Facebook is going to invest a bunch of money into Meta.
What's that?
And I don't know. And Facebook is going to invest a ton of money into Meta.
Bingo. Thank you. Because that's exactly right. If I look at it on a PE ratio, or PE basis, I'm like, oh man, screaming deal. But I know something about Facebook because I'm watching TV and reading articles and blah, blah, blah. And I know they're about to invest $5 billion in building out the Web 3.0. And that right. can't be very profitable. And the market knows this too. And that's probably why it's trading at this low PE. So using these PEs against historic PEs is a great way to screen. But it's not the end of the story. It's the start of the story. It's chapter 1. Right. Now you have to find out, I wonder why that PE is so low. Because often if companies are going to start doing less well in the future, of course their PE is going to come down. Because the E part of the PE is going to get smaller, right? And so you have to know why. So I know most of the people listening to this are doing S&P 500. And there's no problem with that at all. But if you are a stock picker like I am, then you need to, get into some of the details and track these things and then make decisions like that. Obviously,
is that 16 PE ratio of Facebook? Is that kind of like having the $500 billion machine Meta already built in to that PE ratio?
Well, yes, that's why the PE ratio is so low, Aaron, because it's
already built into. So it's built into that new stock price. Does it still make it a bargain?
Well, it makes it, I mean, it's trading at historically low PE, but it's not as much. If earnings were growing 30% a year, this is another way that you gauge stocks. If your PE ratio is less than your growth percentage, that's a good sign. So in other words, my PE ratio is 16, but the company's revenue is growing 30% a year. Well, that's excellent. But now, so what we've got to do next with the reason our PE is so low is because we're not going to grow at 30% a year. We might not grow at 10% next year, even though historically, see, when people were paying 30 times earnings for Facebook, it was growing at 50 times, So that made it worth it. If it's not going to grow next year, then 16 times earnings may be too much. Does that make sense? So you've got to do a little more research before you can make a decision on stuff like that.
Gotcha.
But the easy thing to do is what Miranda does, even though I make fun of her. Investing the same amount, dollar cost averaging is one of the only mathematical systems proven to be good because it forces you to buy more shares when prices are low, like they are now, and it has you buying less shares when prices are high. So obviously doing that every month is a good idea. And you should never stop just because the market goes down, because that's when you're buying the stuff on sale. And I had another note I was going to share. Let me see if I can find it real quick. Because we're talking really about market timing. And market timing, generally speaking, is a dumb idea.
Yeah, and we talked about this a little bit, saying, it's kind of like market timing light, where we're like, well, I'm putting more in now that it's going down. Am I going to miss the bottom? Probably. I will probably miss the absolute bottom. But I'm still getting some good deals. I'm still getting a discount, and at least I'm not locking in losses.
Yeah. And here's a quote that I put in my notes for today. If you invested in the S&P 500 at the start of the century, in the year 2000, you'd have earned about 6% a year on average to now. But if you missed out on just 10 days of the last 20 years, you'd have earned 2.44%. So sitting on the sidelines can be a very dangerous thing to do. Trying to pick a bottom, dumb. Right. And many pundits have become famous doing that, but none have succeeded over the long term. And I could name 10, because sometimes people are right, but no one's always right all the time. There are just too many variables. So be cautious if you're going to try to pick a bottom. I'm trying to pick a bottom. I'm trying to add to my positions at a lower price. And I see reasons why the market might go lower from here. More interest rate hikes, for example, are coming. But I'm going to start buying pretty soon, because I'm not nearly smart enough to pick the bottom of the market.
I was going to say some positive things too. I read an article recently where quite a few technology sectors have been saying that they are they're past halfway through the supply chain bottleneck problems. Mm-hmm. And if you don't want to get into all these P ratios and everything, sometimes you could just read a little thing and go, oh, I guess it's a good direction. Like I just saw a blip on Sony saying that they're going to produce a ton of PS5s, their brand new gaming system. That's an indicator of a supply chain positive.
Yeah.
When those little things will add up, and so even though we have a war and we have China who's got their COVID issues over there, that the supply chain issue is one of those things we've been waiting for.
Yep.
To go in the reversal.
And remember too that the stock market is a discounting mechanism of the future. So, sure, one day the war in Ukraine is going to end. One day inflation is going to be tamed. One day gas prices are going to come back down. But guess what? The train will have left the station 2 months before that happens. Don't think you can wait till all these problems are solved and get into the bottom, because the stock market's going to anticipate that. It's going to start going up look what it did during the COVID thing. Right. It crashed. In like 2 days, it was down 20%. But then people went, oh, wait a minute, though. COVID's not going to last forever. And we had one of the best bull markets of the century.
Yeah.
So, be aware. So don't try to get at the bottom. Put in a little. Don't put in everything. I think it's going to fall farther. I wouldn't put in everything here. But I'm not going to be sitting on the sidelines. I've played this game before. I'm not going to be sitting on the sidelines just in case.
And I will remind everybody who listens to this podcast, Stacy has been correct about a lot of things.
I did say the market was going to fall.
I wrote a note a long time ago that Stacy told me, he goes, hey, when interest rates rise, people sell their stocks and they put it back into safe havens, and the market comes down, and it's exactly what happened.
Yeah, and unfortunately, I said I'm going to sell everything, and I didn't. And I'm just going to buy more. Before we leave, and we do have to quit, I want 5 specific quick tips for those of you out there, keeping in mind to whenever you invest, however you invest. 1, have a plan. What are you investing for? What is your time horizon? What are you trying to accomplish? 2, think long term. The amount of money, it's easy to make money in the stock market over time. It's impossible to make it over an hour. Mm-hmm. Nobody knows where the market's going tomorrow. But I'll guarantee you 10 years from now, it's going to be higher. Know what your time horizon is. If you want to be a day trader, God love you, I can't help you. Number 3, understand volatility. Understand that when things go up 20% in 3 years in a row, that the shoe is going to drop. You've got to know that. Don't freak out when that happens. Know that it's going to and be prepared for it. Number 4, diversify. Diversify among your investments in the stock market. Diversify among your investments, period. If you've got a lot in the stock market, how about some real estate? Look around, understand what different investments are, and we have podcasts on that. And finally, number 5, expect to be wrong. You will be. I've made so many mistakes in the stock market. Peter Lynch, he was a famous investor. He used to run the Fidelity Magellan Fund. He said, I'm happy if I get 3 stocks that go up out of the 10 that I pick, because those that go up, they go up a lot. It's kind of like you can be the best baseball player in the world, by batting 40%. So expect to be wrong on some of your investments because you will be. And cut your losses short and let your profits run. And that's the opposite. Trust me, I used to be a stockbroker. What people do is they go, I can't get broke taking a profit. And they'll take a profit of 2 points on a stock. And then they won't sell something at a loss because they're going to wait for it to come back and it goes to zero. What you want to do is sell your losers and let your profits, your profitable positions go forever. That's why I bought Apple at $1.50 and I still own it today at $145. So anyway, these are things to keep in mind. And that's, any other last notes? Because we're going way over.
I think that's really, no, I think that's really good. I think the important thing that you mentioned is you have that goal, you have that plan. And that's kind of what keeps me sane when this stuff happens, because it's like, I have a plan. This X dollars are going every month into my travel fund, my retirement, all of the, and it's all divided up and it all goes in there, same place every month. And then I have a little bit of extra that if I want to do some bargain hunting, I can. But having that plan and those reminders are just so important to help you, not panic when this happens.
Yes. And even though I've been through this, I've been doing this for 40 years and I've been through this many times. And believe me, I every now and then I go, oh my God, what am I doing? I should have sold, blah, blah, blah. And then I have to say to myself, put your big boy pants on. You know what game you were playing. You played it before. You're not going to, these things will come back before you die. And even if they don't, it's not your problem.
Right.
It'll be my wife's problem. But
see, it's all good. It's all good.
Yeah, it's all good. So we are out of time, guys. Do you have nothing else, Aaron? Okay, we're out of time. We are not out of topic, though. Dig a little deeper. Find links to more info in our show notes. And remember, if your goal is to make more, to spend less, to retire rich, your online home is moneytalksnews.com. And don't forget to check out Miranda's online home as well. That's Miranda Marquit, MARQUIT.com. If you got a question, comment, or topic you'd like to suggest, tell us. You can email us at hello@moneytalksnews.com. That's hello@moneytalksnews.com. And one final thing, if you like what we do, then do something for us. Subscribe to our podcast. Takes you 2 seconds. Really helps us, though. So if you like us, don't just sit there. Show us and subscribe and tell your friends, too. I'm Stacy Johnson.
I'm Miranda Marquit.
Let's go pick some winners.
Let's do it. Thanks for hanging out with us, guys. We're going to see you right here next time.